Hi, I'm Josh Brown here with my partner Barry Ritholtz. President Trump recently announced he'd like to have the SEC look into reducing the reporting requirements for public companies from quarterly to twice a year. Is that a good idea or is it backwards? We'll find out. Stick around. Barry, you wrote a post about the frequency of companies reporting earnings. Right now, you've got to file with the exchanges and with the regulators 4 times a year, quarterly reports on profits, revenue, any extraordinary items that shareholders should get a disclosure on, etc. And the president thinks that maybe it's better for business and as a result hiring if companies are relieved of that burden and they can just report twice a year. I actually don't hate that idea, but I think you do.
It's not that I hate it, it's just counterproductive. If you think about the whole backdrop to this, we want companies to think long term. We want companies to think about investing in themselves, investing in their companies, hiring people, doing R&D, and the thought process is, well, if we don't have to report every quarter, we could be less short term. But stop and think about what happens. If we report every other quarter, everyone is going to be hyper-focused on that. If, heaven forbid, a company misses on revenue numbers or profits, the stock would get absolutely demolished.
You're saying the semi-annual report, it'll be like Christmas morning effect.
Exactly.
Where people like rip open the wrapping, oh, I've been waiting so long, and then it's going to be an outsized reaction in the stock price, good or bad, depending on how far away it is from estimate. But don't we have that anyway? Don't stocks make outrageous moves after quarterly reports?
Sometimes. So here's the solution. When you look at most companies, they use software, business intelligence software, and their own internal data. Not only do they get updated monthly, they get updated weekly and daily. And if you
internally, not shareholders.
Internally, right. So if you want something to matter less, rather than report it less frequently, report it more frequently. If you reported earnings, provisional earnings each month, and then you do a quarterly update of the 3 prior provisional, the impact is far less significant than. And by the way, eventually this should just be a daily real-time update.
I'm going to push back a little on that, though, only by saying we're already getting a version of that. Like, let's say you're a publicly traded retailer. You're giving me same-store sales monthly. Now, you're a technology company. You're probably doing a mid-quarter update. And then probably once or twice a year, you have people on a roadshow. And then you have people doing analyst day. And then so it's not really 4 times a year that you're making a public pronouncement to the street. It's more likely if you're a Fortune 500 company that you're talking to the street monthly. And in some cases, it's probably too much information. So and we still have stock market volatility.
So here's the exact response.
I don't know what the right answer is, but more, I don't think, can be the answer.
So here's the right response. We're getting 4 quarterly earnings and a whole bunch of spin and bullshit and massaging
That's true.
and nonsense all the time. So there's no SEC requirement that you have an analyst day or that you do weekly or monthly sales. And by the way, how many companies have stopped reporting weekly same-store sales because they didn't like the reaction to it? But once we move, I mean, the ultimate optimal situation would be real-time, like you log into your portfolio and see everything to the 10th of a cent. If we had real-time updates or daily updates from companies, you get rid of all of the accounting nonsense. You get rid of that end of quarter, do anything to sell another Chevy Tahoe and pull it back from next year's sales into this year.
But how do you know? But the sales cycle for a majority of things that get bought and sold in this economy is not point of transaction. It's not like
it's seasonal.
Well, a business selling services, the sales process is 9 months. How would a daily look at that have any meaning at all?
So
that's what you're getting to.
That's
is
the
that
whole
there is
point.
No meaning.
You completely eliminate it, and what you end up with is the sales trend up or is the sales trend down?
And people will get daily data or weekly data, but they'll start ignoring it because they recognize, oh, this actually didn't have any meaning.
Right, it's all that little noise. Now we have these big, noisy quarterly events. you can smooth that out, not by reporting once a year or twice a year, but reporting monthly, weekly, daily, and eventually that goes
all the
away.
hand motions out.
Jewish, Italian, it's the same thing.
Are you from Brooklyn or Long Island?
Hey.
All right. Well, wait. So now you mentioned in the piece that you wrote something about what we did internally, which I hadn't
years and years ago at a prior firm.
Well, don't ruin it. I hadn't thought about this, but it's a good analog. So a million years ago, you and I, when we first started working with clients, we would send out quarterly reports. And we used Morningstar Office, and we literally printed on paper, or we generated PDFs, depending on what the client wanted. And
almost all of them were printed. I remember do you remember stuff spread out on the floor and inserting in envelopes?
It was absurd.
It was crazy.
So anyway, we were collating performance reports, and we were saying as we were doing it, quarterly. Like, these people are planning 30-year retirements.
Right.
It's so dumb. But we did it because it was like a convention in the industry that's just what you do.
And then the phones and the email would light up. So it was like, what does this mean? Am I doing well? Am I doing poorly?
Sometimes it was good, sometimes it was bad. So right. So then we started working with Orion, and there were other providers, but basically we said, you know what? Here's your performance every minute of every day.
Here's
Log in,
right.
Run your own. If you want to know how have I done between Passover and Easter, run that 9-day report. I don't care.
I'm fond of saying you could check your portfolio tick by tick, but please don't. Yeah. You should really be using this so you know it's there. And once people figure out, I don't have to wait for a quarterly update, I don't even have to wait for a monthly update. Oh, I always have access to it?
Who cares?
Nobody cares about it anymore. Suddenly, the big event goes away, and the question becomes, is my trend on target to achieve the goals of my plan? If we do the same thing with quarterly earnings, hey, are earnings expanding? Are the long-term plans of this company doing what it's supposed to do? Or is it GE and all the various divisions are going?
Right. So if you let people see how they did intraday, close of business, how did I do this week? If you give them that access for the next 2 or 3 weeks, they'll feel like a kid in the candy store. They'll log in, and then you see it start to trail off. And then you see people really only start to log in on maybe a very volatile market.
Right.
But I think that's a really great point, and maybe if you gave people that level of constant transparency into all the noise that goes on running a public company, maybe it would have a similar effect. My last question is, would Wall Street analysts get better or worse at having consensus estimates match reality if they had that granular a level of access, or would it make no difference to them either? I don't know.
So that's a great question. And what I would tell you is you would have some analysts who wouldn't be able to adapt to it, and then you would have other analysts who would find a completely different set of ways of parsing the data. Hey, is this a seasonal issue? Is this something that the company looked at compared to year over year? How do the numbers look like? What other divisions of the company are doing better or worse? The ability to parse
but then that methodology would become widespread, and then any edge would be gone.
But the process of transitioning to that means the big focus on the quarter goes away, the claims of short-termism go away, and you end up with what is the long-term trend of the company's sales, revenue growth, and profits, and are we really thinking long-term? And that's what we want Wall Street and public companies to be focused on.
All right, I'm going to have the final word on this one, if you don't mind. So you have 50 analysts covering Walmart. The stock goes up 15% the day after reporting an amazing earnings quote. So you have 50 analysts, probably all of them making high six figures or mid six figures. Then you have all the hedge funds buying and selling, and all the mutual funds, and asset managers, and individual investors. And tons of information. And my friend Barbarian Capital mentions you've got people with satellite cameras counting cars in the fucking parking lot in Walmarts all over the country. And you still get it wrong, and you still get a 15% reaction in the stock the next day. So all of the granularity you want, you can count cars in parking lots until your head falls off. At the end of the day, companies are going to do what they do, businesses are going to do what they do, and thinking that you have more information, unfortunately, it won't necessarily be better information. That's all I would say.
We'll find out.
You okay with that?
Sure.
All right. If you have any opinion or anything to say on the topic of the frequency of corporate earnings, Tell us in the comments section below. We love your feedback, and we'll see you soon.